The Coca-Cola company is set to announce their quarter 3 earnings on October 21st, which is Tuesday next week. Now, with this in mind, I want to jump to Money Sense and have a look at the company's fundamentals as well as calculate their intrinsic value. Now, first going to the summary page, we can see that through the past 5 years, Coca-Cola is up by only about 34%, which is well below average. Now, over the past 6 months, they have actually dropped by about 7.5%, meaning that right now, before they announce their quarter 3 earnings, might be a good time to buy the company undervalued. Now, to figure out if the company is actually undervalued and if you might want to start buying in at the current trading price, we will jump to the 9-pillar analysis, where we will first have a look at the financial growth. Now, first looking at the revenue growth, you can see that through the past 10 years, the revenue has increased by only about 6.25%, from 44 billion in 2015 to 47 billion in 2024. So you can see that the 10-year revenue CAGR is sitting really low at only 0.68%, meaning that the revenue growth rate wouldn't even be able to beat the long-term average inflation growth rate. And that is why we have to rate the first pillar, revenue growth, as a C. Now, moving to pillar 2, that is the net income, that is actually looking quite better. As you can see, the 10-year net income CAGR is sitting at 4.18%, with the 5 years sitting at 8.23%. Now, the reason for this is when we jump to pillar 4, you can see that the profit margin of the company has actually increased from 16.60% in 2015 to about 25% in 2021. So in the years when the revenue has been decreasing, Coca-Cola increased their profit margin, and that's why their net income has actually been increasing. And then since 2021, the revenue actually has been growing again. And that's why even though the profit margin has been decreasing slightly, the net income has actually kept increasing. So this is actually something I like about Coca-Cola, because even though their revenue growth was lacking behind through the past 10 years, they did manage to grow their net income at a decent rate of about 4.18% through the past 10 years. And that's why we will give the net income a B grade. Now, moving to pillar 3, the free cash flow. And as you can see, that isn't looking too good. In 2024, the free cash flow dropped to $4.7 billion, which is the lowest through the past 10 years, meaning that the 10-year free cash flow CAGR is sitting at -5%, with the 5 years sitting at -11.37%. Now, when we disregard 2024, from 2015, the free cash flow has actually increased by only about 1.7 billion into 2023, which still is a very low CAGR. So that's why we'll give the free cash flow growth a C grade as well. Now, looking to the profit margin, which we already kind of looked at, you can see that Coca-Cola has actually managed to increase it through the past 10 years at a decent CAGR of 3.49%. The profit margin is sitting above 10%, and that's why we will give the profit margin an A grade. Now, moving to pillar 5 and pillar 6, these two pillars are the valuation of the company. So as you can see, for pillar 5, we want the 5-year P/E ratio to be below 22.5. Now, when we scroll down, you can see that the 5-year P/E ratio average is actually sitting at 26.88, with the 10-year average looking to be sitting at 40, but the reason for this is a big outliner in 2017. On average, through the past 10 years, the P/E ratio seems to be sitting between 26 and 30. Now, currently, the P/E ratio is sitting at only 23.87, which, as you can see, is probably the lowest level it has been through the past 10 years or so, meaning that right now might be a great opportunity to buy the company at a discounted price. Now, even though the company is trading at a discounted price, I will rate them as a B, because I do not believe that a company that is growing their net income at a 10-year CAGR of 4% and a 5-year CAGR of 8% deserves a P/E ratio of more than 20. And that's why I'm rating them as a B, even though they are trading cheaper than what they have been trading through the past 10 years. Now, moving to pillar 6, where we will have a look at the price to free cash flow. When we scroll down, you can see that currently the price to free cash flow is actually sitting at negative 402. And that is because in Q1, I believe Coca-Cola had negative free cash flow. If we have a look at the quarterly statement and move to the cash flow statement, you can see that the free cash flow indeed was negative 5.5 billion in Q1 of 2025 and negative 1.7 billion in Q3 2024. So when we take the TTM price to free cash flow, it actually comes out to be negative 402, which is not great at all. You can see that already in 2024, the price to free cash flow was much higher than the 10-year average. And right now, well, it is sitting in the negative, even though I do believe that Coca-Cola will manage to have positive free cash flow in the near-term future. I will have to rate pillar 6 as a C. So now that we are finished with pillar 6, let's move to pillar 7, which is the dividend growth. As we can see, through the past 10 years, the dividend CAGR is sitting at 4%, with the 5-year dividend CAGR sitting at 3.5%. Now, for me, these CAGRs are quite low, but Coca-Cola does have a very decent dividend yield of 3.12%. So combining the dividend yield with the okay CAGR of 3.5%, I think that the dividends do deserve a B grade. Now, one more thing I do want to have a look at regarding the dividends is the free cash flow payout ratio. As you can see, through the past 10 years, on average, the free cash flow payout ratio has been sitting at about 95.50%. Now, this average has been raised up by the 2024 free cash flow payout ratio, which is sitting at 176%. On average, through the past 5 years, it has been sitting at about 80%, which is actually an improvement from the previous 5 years, where 2017 and 18 were both above 100%. Now, companies such as Coca-Cola, I'm fine with them having a free cash flow payout ratio of around 80%, as they don't need to push a lot of that free cash flow into innovation. I still do like them to have about 20% of free cash flow to be able to, for example, pay down debt or increase their dividend or buy back shares. So a payout ratio of more than 100% certainly isn't a good sign, but I guess we will have to wait until 2025 to see if the free cash flow payout ratio gets any better. Now, moving to pillar 8, which is the debt analysis. And here we can just quickly have a look at the long-term liabilities of Coca-Cola. You can see that they're sitting at about $49 billion. Looking at the long-term liabilities over the 5-year free cash flow negative dividends ratio, that is sitting at 1.11, meaning that Coca-Cola, with the free cash flow they generate on average yearly through the past 5 years, they can pay off their long-term liabilities, all of their long-term liabilities, in about 5 to 6 years, which is very nice. So we don't need to be afraid about Coca-Cola having too much debt. So we will rate this pillar as an A. And finally, moving to pillar 9, the 10-year decreasing shares outstanding. Coca-Cola hasn't actually been buying back many shares at all, which is something I find interesting, as I would expect Coca-Cola, a well-established company, to buy back a lot of their shares to increase value to investors. But they didn't. I mean, through the past 5 years, they've actually sold out on average shares. So that kind of boggles my mind, and I will give this pillar a D actually, as I want the companies in my portfolio to be buying back shares and raising value for investors. Now that we have gone through the 9-pillar analysis, we can actually quickly jump to the final rating and have a look at the rating. Overall, the financial growth is sitting at around a C grade, which means a hold grade essentially. The profitability is an A grade. The price to earnings and price to free cash flow, so essentially the valuation of the company, something between a B and a C, so not too great either. They have safe dividends, they have very safe debt, but they are not buying back shares. Overall, the grade is sitting at a B, which is considered a buy rating, but we still have to go through the intrinsic valuation. So jumping first to the Graham's formula, I will plug in the maximum earnings per share CAGR into the future at 8%, medium at 7, and low at 5. This will give us an average growth into the future of 6.67%. Now scrolling down, we can see that we also have to input the 5-year earnings per share average, which we can alter based on what we believe is a good starting point to calculate the grams formula. Normally we use the 5-year earnings per share average, but as you can see, currently the earnings per share for Coca-Cola is sitting at $2.83. So that's what I will plug in. We'll go with 2.83. And as you can see, this will give us an intrinsic value of $43.38, which is 35.82% lower than the current trading price. Now we can also go through the P-Challenge model, which uses the same earnings growth estimate, uses the 5-year trailing P ratio. As we saw, the P ratio is currently sitting at about 23, so if I plug that in, we will get an intrinsic value of 28.54, 57.77% lower than the current trading price. So as we can see, based on the company's earnings per share, their value isn't really up to standards. Now moving to the discounted cash flow model, we will calculate the intrinsic value based on the future free cash flow. Now, through the past 10 years, the free cash flow has been decreasing. Through the past 10 years, it has decreased as well. Into the future, I believe that it will increase. So I will go with a maximum CAGR of 8%, medium at 7%, and low at 5%. I will actually go with the same CAGRs as for the net income. Now, Coca-Cola has a really low WACC, weighted average cost of capital, meaning that investors don't really need too much returns from Coca-Cola. That's why we will plug in the maximum discount rate at 6%, medium I will go with 5%, and low I will go with 4%, which will give us a discount rate of 5%, very close to the WACC of the company. And this would actually give us an intrinsic value of $111.34, which without a safety margin is 64% higher than the current trading price. Now, the reason for this is the low discount rate. If we actually wanted average returns from Coca-Cola, say the maximum discount rate at 12%, medium we can go with 10%, and low we can go with 9%, this would give us a discount rate of 10.33%. You can see that that would actually be almost 60% lower than the current trading price. Normally, I personally like to go for 8% discount rate. So if I plug that in all the way through, the difference would actually now be 35%, with the intrinsic value sitting at $43.73, which is quite lower than the current trading price. Now moving to the multiples valuation, we'll compare Coca-Cola to Pepsi. And as you can see, that will actually give us an intrinsic value of $78.77. If we scroll down, you can see that the P ratio of Pepsi is actually quite higher than the P ratio of Coca-Cola. Their price to book values are very similar, but Pepsi has a slight upper hand, well, a big upper hand on the price to free cash flow, sitting at 22.48, while Coca-Cola's is negative. Even through this, Coca-Cola still gets a better rating than Pepsi, with an intrinsic value of $78.77, about 5% higher than the current trading price, getting a C grade. And finally, moving to the dividend discount model, as we saw, Coca-Cola's dividends are growing at a long-term average of between 3.5 to 4%. So I will go with a maximum CAGR of 4%, medium of 3.5%, and low I will go with 3%, which will give us an average of 3.5%. The discount rate for the company we entered as 8%. If we enter the same discount rate without a safety margin, we get an intrinsic value of $44.62, 34% lower than the current trading price. So now when we jump to the ultimate valuation and look at all the models, we will actually get an intrinsic value of $47.81, which is about 30% lower than the current trading price. And with a margin of safety of 10%, we would get an acceptable buy price at $43.03. Now, what we have to understand is that Coca-Cola is a huge company. They are very stable and they have a very stable fan base, and I don't believe that they will go anywhere anytime soon. But as we saw, their financials aren't growing too well, and despite the fact that their financials aren't growing too well, they are priced quite expensively, which we can see both through the intrinsic valuation and by looking at the PE and price to free cash flow ratios. So personally, I certainly wouldn't add this company to my portfolio at their current trading price. As you can see, the rating through the intrinsic valuation models is a D. With that, I hope that you enjoyed the video. If you'd like to check out the tools MoneySense has to offer, the 9-pillar analysis and the intrinsic valuation calculations, you can use the link down below in the description to get a 7-day free trial and 20% off for the first month. And also make sure to leave a like and subscribe, as it really helps me out.